people, we are back. Yes, it's been a while, but it doesn't mean that we can still not pick up from where we are. So, yeah, we have changed things, but we're still the same. We are together. Now, let us do bank reconciliation statement, right? We're going to be doing chapter 2, paper 2 chapters, right? So, we're going to start with bank reconciliation statement. I'm going to start it with a bit of theory to make sure that you understand. Bank reconciliation statement has to have an understanding of the smallest things that happen in our daily lives, which means that you would have to understand when you have a bank account and what happens with that bank provider. So let's use ABSA as an example and use you as the individual. You always see yourself as a company. You have to actually see yourself as a company to understand these concepts. So I'm saying you as an individual, I'm referring to you as a company, right? ABSA, you take yourself, you open an account with ABSA, right? You opening an account with ABSA, it means that every single month, ABSA will be issuing out a bank statement, right? So you're going to have ABSA, which issues out a then you have you as the company, right? Now, ABSA issues out a bank statement. When ABSA makes a mistake on their bank statement, you rectify it in the bank reconciliation statement. This is what is bank reconciliation statement is about. I as the individual or you as the individual, which is the company, the amount in the bank account has to be the same amount in the bank statement. The amount that I'm saying I paid has to be the same one that ABSA says you paid, right? Now, we are doing this to be fixing those errors, right? Now, we have to be on the same page that the individual, which is the company, would be preparing the CPJ and the CRJ, right? When you are preparing the CPJ and the CRJ, you account for it in the bank account. Are we together? Now, here you'll have CPJ and CRJ. You'll have those two journals. You are preparing the journals. You're preparing CPJ, CRJ. Now, I did say when we're fixing an error in the bank statement, we are going to be notifying ABSA or I didn't pay 5,000, I actually paid 2,000. You're going to be doing that in the bank reconciliation statement. So it's going to be here. Right. Now, this is accounted for in the bank account. So let's start with the side. You have your bank account. I did teach you debt click. I did go through the concept of debt click, which means that you debit all expenses, assets, drawings, and you credit all liabilities, incomes, and capital, right? Now, the bank is actually an asset, right? So it means that you will have an increase on your debit side, right? Which then means that bank is an asset to you. But think of it logically. You have 5,000. You have given it to ABSA. What is it for ABSA? Because ABSA has to pay back this money. If I gave them 5,000, if I want 5,000 tomorrow, I'm like, take out my money. They have to give it back. That gives a concept of a liability. And I'm saying with debt click, you credit liabilities because you credit all liabilities, incomes, and capital. So it means that the bank reconciliation statement would have these contra accounts. Let's prove it. Let's prove it. Prove it, right? It will have these contra signs. I have a positive, right? I have a positive in the bank account. For every debit entry, there's a corresponding credit entry. Now, if this moves from this side, it's going to come to the side because it is positive, right? and it is on the debit side, so it's going to move and come on this side. It's going to be positive. This says to us that we are correct with saying the bank reconciliation statement actually has an increase on the credit side and bank has an increase on the debit side, right? Now, this is a liability. This would be an asset. Just so you don't confuse them. Ne? This would be the liability. Now, let's start on this side. You're going to have bank, right? You have a bank. It's an asset, but it can happen that you have a bank overdraft. You having a bank overdraft means that you owe ABSA more. You have used more than your credit limit. You have used more than the 5,000 that you have had, which means that the balance would be here. So you'd have balance BD, and then you'd have balance. Don't worry, I'm going to explain this. So this one here would be unfavorable. This one here would be favorable. Remember what I said? You always make sure that you have one of them. You can't have both of them at the same time. It doesn't make sense. You have to have both of them, right? Now, you having favorable or favorable or unfavorable bank balance. These ones don't change. Always on the debit side, you'll have your receipts, your total receipts. Let me put a T there, and you'll have CRJ. This side you'll have your total payments. CPJ. Right, you'll have your CPJ that side. Now, it means that if they tell you that there was an invoice in the bank statement that you didn't account for, you will take that invoice and put it here. If they say there's an outstanding EFT that you didn't account for, you put it this side, on the credit side. Which means that if it's on the credit side, check which journal is it close to, right? Now, that EFT will be close to the cash payment journal. You see the cash payment journal is the one on the credit side, which means you go and fix it on the cash payment journal. If they say it is an invoice and it was not accounted for, you go to your CRJ. Now, there's one that they always make a mistake. They always leave out. Now, it's not necessarily they leave out. Let me explain it like this. If you get a bank statement, you're most likely to see bank charges there. But you don't know from the top of your head that this month I'll be charged 500 for bank charges. So you always find out with your bank statement. So when the bank statement comes month end, that's when you see that, oh, I actually paid 500 of bank charges. That bank charges comes here. Your bank charges are always credited on your bank account, which means that you account for them in your CPJ all the time. They won't say bank charges were not included in their balances. They're going to just say bank charges 500 US dollars. What am I going to do with them? What you're going to do with them is that you're going to take them and put them in your CPJ, which you'll be finding out by your bank account. That bank charges is closer to CPJ, which means that I'm going to fix it in my CPJ. Now, your interest on investment, for instance, interest income, could also mature, and then you'll have to put it on your debit side, right? So I just need to explain this. Whatever invoice is missing, you put it on the credit side. On the debit side, whatever payment is missing, you put it on the credit side. Now, let's go with errors. If they say there is an error of an invoice, it wasn't an invoice, there's an error. It was not for us, and we accounted for it in our account. You fix it on your credit side. Remember, invoices are usually in here. So them being under your debit, you're going to fix it by putting the amount on the credit. So it has a negative effect. Look at this. It will be plus 500. And then now you're going to see minus 500. It means that it will have a zero effect. That's how you fix an error. All right. Same vice versa. If it was on your credit, you will obviously put it on your debit. That's how you do it, right? Now, after you create this bank account, you have to have balances. You have to have balances. You're going to close off your account and then you're going to have balance. Let's just say this side is bigger. You'll have balance carried down and then you move it to your, because this would be at the beginning. This amount that you'd have here has an effect on your bank reconciliation because it has to be the same. The sides of your bank reconciliation statement has to be the same and they have to balance. Now, bank reconciliation statement is a liability to the bank. We know that, right? Now, bank reconciliation statement, it says that you're going to debit all EFTs, all bank charges, all fees. What I'm going to be doing on the right for bank, if you have the concept of bank, you will even eventually have the concept of bank reconciliation, because what I do on the left, I must do on the right. Basically, it's that concept. If I give you, you must give me back, right? And then it's just I'm giving you, you're giving me, but it's in opposite direction. So just check whether it says there's an error in the statements or in the journals. In the journals rather, you're going to account for it in the journals and in the bank account. When they say there's errors in the bank reconciliation statement, you're going to account for it in the bank reconciliation statement. In the next video, we're going to be attempting questions where this will actually be practical. For now, I just want you to understand the concept that ndiyakunika uyandinika. It is left and right. Basically, it is an asset, it's a liability. I increase, you also increase, but you increase in an opposite side, right? I guess that is all for this video. But in the next video, we'll be attempting a question based on bank reconciliation, and we'll be tackling it together to see all the sides of how bank reconciliation can be tested and does it balance. It's supposed to balance. It has to balance. It has to balance. You don't leave the exam room without it balancing. If it doesn't balance, you make sure it balances so you get your principal marks. But from me to you for now, for this video, it is bye and see you in the next video.